Hello friends, welcome to my channel. In this video, we will look at dividend investing and how to avoid value trap. Dividend stocks are one of the popular ways for investors to invest in the stock market because dividend stocks pay regular dividends, which helps to increase the total returns for the investors. However, there are some dividend stocks which kind of give you negative total returns in the long run. So in this video, we'll try to look at how to avoid falling into the value trap while choosing the dividend stocks. Okay, let's first see what are the typical expectations of an investor while investing in dividend stocks versus the reality. When an investor invests in a dividend stocks, the typical expectation is that the company will keep on increasing dividends over the long run, and the investor is also expecting a high, and if not a very high, at least a modest share price appreciation. So the expectation is that investor expects both the price returns as well as the growing dividend returns. However, in most cases, what happens in reality is that once an investor invests into a share, into a dividend share, um, eventually he or she finds that the company has cut the dividends. To make matter worse, along with the dividend cuts, the share price also falls in the long run. As a result of which, the total share price loss is more than the dividend gain, leading to negative share price, leading to negative total returns for the investor. So that's why dividend investing is a bit tricky. It's not that straightforward as most investors think. So let's look at some case studies. We'll look at AT&T as a example of a case where the investor has received total negative returns, and we'll also look at the case study of J&J Johnson and Johnson, where the investor has been handsomely rewarded over the long run. Okay. Before that, let's look at what are the common mistakes that an investor does while choosing dividend stock. One of the common mistakes that a new investor does is investor blindly go for the high dividend yield. Dividend yield is nothing but your dividend per share divided by your share price. It basically gives you an indication of what is the yield on a stock. Many new investors are tempted to filter shares which have dividend yields of more than 8-9%, and in the long run such kind of stocks are not able to sustain the dividend, leading to a negative total returns for the investor. The the second mistake is that while investing in a stock, investor ignores the fundamental of the business. That is, for example, an investor invest in a company which don't even generate any positive free cash flow, and without free cash flow, any company will not be able to pay dividend to the shareholders, because free cash flow is the real cash that is being generated out of the business. The third point is that many investors just focus on the dividend yield and not pay attention to the payout ratio. Payout ratio is nothing but your dividend divided by your net income. Payout ratio show what percentage of your net income is being paid as dividend. Now, in typically a ratio of greater than 80% is a red flag. The So any company which pays more than 80% as dividend doesn't have any cash left or enough cash left to reinvest into the business, which leads to overall negative total returns in the long run. And another point is that investors thinks that at the point of investing, whatever the dividend he or she sees, that will sustain in the long run. But while investing, investor has to acknowledge that dividends are not share. That is why investing in a fundamentally sound business is paramount while making a decision to choose a dividend stock. Okay, now let's look at a case study. We will pick up AT&T. AT&T is a classic case where investors, even after holding the shares for more than 2 decades, still in negative returns. So this particular stock has led to massive shareholder destruction over time. The total share price loss is greater than the dividends received. And one of the key reason is that the company has historically have a high debt. As of 2023, it has around 126 billion of USD of debt on its book, and also the return on invested capital is return less than the weighted average cost of capital. Now, any business where return on invested capital is less than weighted average cost of capital will not be able to generate positive total shareholder return in the long run. And another point is that it's because of bad merger acquisition decisions that the company did. The company bought DirecTV for $67 billion, and when the cord cutting trend started to happen, it was unable to retain the customers, leading to revenue loss. It missed the pivot to streaming. Company like Netflix entered the market, and the streaming market grew by a big margin, while the traditional form of TV were not able to match the revenue growth of the streaming services. So, a combination of all these factors led to the shareholder value destructions for AT&T. Let's look at the total return analysis for this share over the last 24 years. So, I've taken the share price values from July 1999 till July 2023. So the share price has approximately fallen by around 65% in the last 24 years. Even though the dividend yield as of November 2023 is around 7%, but this high dividend yield is because of the falling share price and not because of the increase in dividend. To prove this, you see the dividend for the year 1999 was around 96 cents, while the dividend for the year 2023 was around 1.1 US dollar. So in 24 years, the dividend growth has been pretty modest, just 0.6% per year of dividend growth. While on the other hand, if you look at the share price loss on a compounded annual growth basis, it's around minus 4.32%. So dividend growth only 0.6% and share price loss minus 4.32%. As a result of which the total share price return, the total shareholder return for the whole 24 years has been negative. So this shows us that just blindly committing to a company based on the dividend yield can be very risky. In the long run, shareholders would be better off just holding cash instead of investing in these kind of companies. Now let's look at what is the correct way to choose dividend stocks. The first thing to look at is the stable free cash flow, because free cash flow indicates the real cash that the business is generating. Unlike accounting profit, the managers of a company can manipulate their books to generate accounting profit, but free cash flow shows what is the real cash that the business is throwing every year. So a company with high free cash flow is more likely to sustain dividend and grow dividend over the long term. The second point is low capex. A company which has low capex has more cash left to reinvest into the business. Thus, it will be able to grow the business revenues, thereby generating more free cash flows in every year to pay back the shareholders at dividend. And also, if a company has low debt, it has less interest obligations to serve, leading to more cash availability to service the dividends. The third point is the return on investment capital has to be greater than the weighted average cost of capital. Otherwise, the business is not sustainable. The next point is that the company should have sustainable payout ratio. And when I say sustainable payout ratio, it has to be typically be less than 50%, so that there is enough room for the company to increase dividend in the future. And the last point is track record of growing dividends. A company which has consistently over decades grown dividends, like companies like Coca-Cola, companies like J&J, these companies are likely to kind of sustain the dividends in the future years. Now let's look at the case study of Johnson and Johnson. So this company has created very high shareholder wealth for the investors over the long run, and the shareholder wealth was created both because of healthy dividend growth as well as a healthy share price appreciation. The dividend yield, if you see it, just 3.15% as of 3rd November 2023, even though it's not very high, but it's sustainable. The payout ratio for 2023 was 34.25%. You see, there's enough group room left for the company to increase dividend in the future. The free cash flow for 2023 was 14.5 billion US dollars. So you see, the company is generating massive free cash flows, which can be used to reinvest into the business or pay the dividend to the shareholders. Now let's also look. Now let's also have a look at a similar return analysis as we did for AT&T stock. So for this example, I've taken the price values from November 1999 till November 2023. So the share price has appreciated by around 230% in the last 24 years. The dividend yield is close to 3% as of 3rd November. Although it is modest, but as I said earlier, it is sustainable. The dividends for the year 1999 was around 48 cents, while the dividend for the year 2023 was 4.7 US dollar. So if you see, the dividend growth over the years has been around 9.97%, while the share price growth has been around 5.1%. So you see, the investors from J&J has have gained both from increase in dividend as well as the increase in the share price return. And this is one of the quality, and this is one of the trademarks of a good dividend stock. That means the investor gains both from dividend growth as well as share price growth. Any share which either has dividend cuts or where the share price falls more than the dividend growth, that kind of share is not a good investment. Okay. Okay, that's all I had for this lecture. Thanks for watching. If you like watching such similar high quality education content, please subscribe to my channel. Thank you.